Hey, Year 12. So today we're going to be looking at income statements. We have looked at closing our revenue and expense accounts in the general ledger, and we know that we do that through our profit and loss summary account. And now that we've done that, we're looking at how we actually report this to outside entities. It's all well and good that we have access to it as managers and as accountants, but when we're looking to publicly display this information, we need reports, okay? And that's where the income statement comes in. So we'll be looking at the proper formatting of an income statement. Keep in mind that I'm a little bit limited due to my slideshow. So if you are looking for an example, please do look in the textbook. There's some really fantastic examples. And we'll also be looking at some different types of revenue that we haven't really looked at so far. Okay, so let's jump into it. So we've already looked at the process of closing off our revenue and expense accounts to the profit and loss summary account. We know that this is where we determine our profit and loss. But that's not the final step. We need to display this information formally, and that's why we have our income statement. Now, like all our reports, it needs to follow our qualitative characteristics of reports. So it needs to be understandable, and it needs to have information that can be easily understood, and it needs to be in a consistent format. So what I'm going to show you is a little bit stretched out because, as I said, I'm limited. But there is one format that is approved in VCE, and I really suggest looking at the textbook for a clear-cut example of that. So when we're looking at income statements, we know that it's got to contain the following information. It needs to show our net sales. And what we do next is we try to provide more information to users of the reports. So we show them our gross profit, which is our net sales less cost of goods sold. Your cost of goods sold could be your cartage in, the actual cost of sales, all the different expenses that you need to get your inventory in and ready for sale. We then have our adjusted gross profit, which takes away any inventory losses or adds any inventory gains. We'll then finally show our net profit, which is once we've deducted all of our other expenses. Okay? So let's have a look a little bit closer at the format of it. So we start out with our cash sales. Now you can see this is stretched over 3 columns. Realistically, I would like you guys to do it over 2 columns. This last column isn't really necessary. This calculation can be put down here. Okay? So here we have our cash sales and our credit sales, and less any sales returns that we've had. Okay? This is done because we need to show our users of our reports, hey, here's the sales that we've made. This is a good thing. We actually made $310,000 worth of sales. But you have to understand that only $302,000 made it through to the business. Okay? We then have less cost of goods sold, which in this case is going to be our cost of sales and our cartage inwards. We take this away and we're left with our gross profit. Okay? In this case, we're going to have an inventory loss, so we're left with our adjusted gross profit. Now, here's where we add any other revenues that we might have. Remember, according to our definition, revenues are any inflows of economic benefit or reduction in liability, so any increase in assets or decrease in liabilities that also increases owner's equity. So here we have other revenue. In this case, we've got our interest revenue. Okay? And then we're left with a final figure. This final figure does not have a name. We don't know how to define it. We have thought about it in Australian accounting and in international accounting, and no one can figure out a consistent name for it. So we literally just leave it blank. So if you do have other revenue, you'll have plus other revenue, a figure that we don't have a name for, and then we go on to our other expenses. Okay? Your other expenses are just all the other expenses that occur within the business. This will include your rent, wages, advertising, insurance, and any cartage out, because that's not getting the inventory in and ready for sale. It's getting the inventory out to the customer. And then finally, we're left with our net profit. Okay. Now, a couple of things we need to go through. The first is, what is cost of goods sold? Because we've been looking a lot at cost of sales, but now we need to consider the cost of goods sold. Now, the definition that we use for this is any cost of sales for the period and any and all expenses that we incur getting the inventory into the business, onto the shelves, ready for sale. So this could be cartage inwards, it could be modifications made. Doesn't matter whether it's a product cost or a period cost. If it's getting the inventory in and ready for sale, then it is cost of goods sold. If it's getting the inventory out of the store, then it's not included. So here's a couple of really good examples that we have. So we've got our cost of sales, we've got cartage in, customs duties, we might have buying expenses, okay? Once again, I'm going to say no cartage outwards. Any delivery fees that we have or anything like that, we treat them as other expenses. The last couple of things I want to look at is I want to look at evaluating net profit. And I also want to look at one other type of revenue that's going to come up that we haven't really looked at so far this year. And that is the revenue that we have in discounts. So, firstly, in evaluating profit, once net profit is determined for the period, there are a number of ways in which to evaluate net profit. Now, this comes up in the sense that if I told you your business had earned $10,000 in profit, is that good? You don't know. It could be good if it's your first year and it's just a little part-time business and it's not your full-time thing. But if BHP Billiton only earned $10,000 in profit, then that would be awful. Okay? So we need to compare. So we need to have comparability and understandability in our reports. And we need to actually evaluate whether or not our profit and losses are good things. Okay? So we need to consider the length of the reporting period. If you are earning $10,000 profit in a week, as a sole trader, it's probably going to be a good thing. If that's for a year, probably not a good thing. So we always check our reporting period. You need to look at trends. So compare one period to the last, to the last, to the last. Make sure that the business is heading in a positive direction. We might want to compare it to budgeted or expected net profit. This is important. You might want to compare it to industry averages. You might want to compare it to the hours put in or the financial burden put on the owner. So you might want to consider the return on assets or the return on owner's equity, things like that. So there are a number of different financial indicators you can look at, and I suggest looking in the textbook for a full list of those. We'll be learning about quite a few of them very soon. But in general, you need to consider trends, budgets, industry averages, and financial indicators. They're the four major groups, okay? Now, when it comes to discounts, we might sometimes earn discount revenue because we have paid debts or things like that particularly quickly. This usually happens when we're looking at accounts payable. Now, in cases like this, you would have a discount revenue. You might save $500 or $1,000. You might even save $5,000 over a year. Okay? So we need to consider this saving that we make because this fits our definition of revenue. It might not be an increase in assets, but it is a decrease in liability that also increases owner's equity. Okay? So for that reason, we treat this as another revenue and we put it in that unnamed section in other revenues equals blank figure. Okay? We might also have discount expenses. We might offer a discount to someone like an accounts receivable who pays us particularly quickly. In this case, those discount expenses, they're reducing our assets. They are reducing our accounts receivable, and we're not getting cash in return for it. All it's doing is decreasing our owner's equity. So this needs to be treated as one of our other expenses. So keep in mind that those are occurring, and I'll be using a lot of those in examples throughout this chapter. So let's wrap this up, and we'll look at what we need to get done in the next week or so. Income statements are probably one of the more important reports that we look at. It's certainly a very large topic, and it allows us to have a look at other topics, such as different types of revenues and expenses. It allows us to look at things like our financial indicators and evaluation of business performance. So we'll be using these reports for a long time to come throughout the entire course for the rest of the year. It's really important that you get a good grip on them and understand the formatting, particularly at the start where we have our sales, less cost of goods sold, equals gross profit, plus or minus any inventory losses or gains, equals adjusted gross profit, adding out any other revenues. Okay? If you can stick that one sequence in your head, you will get the formatting absolutely correct every time. And that's a really key thing to learn. Okay? So what I'll do is I'll leave you guys with the questions that I want done from this chapter, and we'll wrap it up with a bit of a meme. Okay, have a great night. Thanks. Bye.